Since 2022, the share of global trade settled outside the dollar has risen. Central banks have bought gold at the fastest pace in decades. Bilateral currency arrangements have multiplied. Every one of those facts is true, and they get assembled into a story about the yuan displacing the dollar. That story is wrong, and the way it is wrong is more interesting than the headline. My argument is this. De-dollarisation is real, but it is not producing a yuan-led system, it is producing fragmentation, where the alternative to the dollar is not another currency but gold, bilateral barter-like arrangements, and higher transaction friction. And the reason is a constraint Beijing has chosen not to remove. By the end you will understand why China cannot have both a controlled capital account and a global reserve currency, and which one it keeps choosing. This closes the loop on the argument I started in video 1. I claimed Russia's yuan balances represent a dependency rather than an escape, because the yuan is not freely convertible. The obvious challenge is that this is temporary, that the yuan is on a path to convertibility and the dependency dissolves as it internationalizes. If that is right, my thesis has a shelf life. If it is wrong, the constraint is durable. So this is the test. It also matters for anyone reading sanctions policy. If the alternative to dollar clearing is friction rather than a functioning parallel system, sanctions degrade more slowly than the headlines suggest. Reserve currency status is not primarily about the size of an economy. If it were, the yuan would already be there. It is about what a foreign central bank can do with a surplus at 3 in the morning during a crisis. It needs a deep market of safe assets it can sell instantly, in size, without moving the price, and without asking anyone's permission. The U.S. Treasury market provides that. It is enormous, liquid, and, critically, open. Nobody has to approve your exit. China's government bond market has grown substantially, but foreign participation is bounded by capital account management. Money enters and leaves under rules Beijing sets and can change. This is the crux, and it is not an oversight. It is a choice with a coherent rationale. The first pillar is the trilemma, and it is not a theory, it is an accounting identity that has broken every country that ignored it. A country can have any two of, a managed exchange rate, free capital movement, and independent monetary policy. Not three. China has chosen exchange rate management and monetary independence. That means capital controls. And capital controls are precisely what disqualifies a currency from reserve status, because reserve status requires that foreigners can always get out. Beijing's reluctance here is informed by direct observation. The 1997 Asian crisis was, in the Chinese reading, a demonstration of what happens to economies that open the capital account and then face a sudden reversal of flows. China's controls were a large part of why it was insulated. And the pressure is not hypothetical. In 2015 and 16, China faced substantial capital outflows and spent heavily from reserves to manage the currency. The lesson taken was that the controls matter, not that they should go. With a large domestic debt load and a property sector under strain, the appetite for opening the capital account is lower now than it was a decade ago, not higher. The second pillar is what countries are actually doing instead, and it is not buying yuan. Central bank gold buying has run at historically elevated levels. Gold pays no interest, costs money to store, and cannot be used to settle a trade invoice. It is a strictly worse transactional asset than any currency. So why buy it? Because it is the only reserve asset that carries no counterparty. It cannot be frozen by anyone else's decision. After 2022 demonstrated that reserves held in another country's system can be immobilized, that property was repriced. The second thing countries are doing is bilateral arrangements, settling specific trade in local currencies, pair by pair. That reduces dollar usage in that pair. It does not create a network. This is the distinction that gets lost. A currency system has network effects, everyone uses it because everyone else does. 100 bilateral arrangements is not a system, it is 100 separate arrangements, each with its own imbalances to settle. And each one leaves someone holding a currency they did not want. Which is exactly the position I described Russia being in. That is not an exception, it is the general case of bilateral settlement without a reserve currency. The fourth pillar is the least technical and, I think, the most decisive. Reserve currencies require a legal system that foreigners trust against the issuer's own government. When a foreign entity holds a dollar asset, it is holding a claim enforceable in courts that have repeatedly ruled against the United States government, against American corporations, and in favor of foreign plaintiffs. That is not sentiment about democracy. It is a specific, checkable property. The issuer of the currency does not control the outcome of disputes over the assets denominated in it. This is why English and New York law govern the overwhelming majority of international financial contracts, including many contracts between two parties with no connection to either jurisdiction. Everyone wants a referee neither side appoints. A yuan-denominated system would require foreign holders to accept that disputes over their assets are resolved in a system where the state is not an independent party. That is a hard sell to a foreign central bank thinking about a crisis. And notice that this constraint is even harder to relax than the capital account. Beijing could open capital flows tomorrow if it decided the trade-off was worth it. Building a judiciary that foreigners believe will rule against the state is not a policy lever. It is a decades-long institutional transformation with domestic political consequences the system is organized to avoid. So when I said the constraint is durable, this is the deepest layer of it. The trilemma is an economic choice. The legal question is a constitutional one. The fifth pillar is the one that would have to fall before any of this changed, and it is smaller and more specific than people expect, the pricing benchmark. Most internationally traded crude prices off a small number of benchmarks, Brent and WTI principally, quoted in dollars, settled through futures markets in London and New York, with decades of liquidity behind them. A benchmark is not a price. It is a reference that thousands of contracts, hedges, and loans are written against. Its value comes entirely from everyone using the same one. That makes benchmarks extraordinarily sticky. A producer can sell a cargo in any currency it likes and still price it off a dollar benchmark, which is exactly what most non-dollar oil deals actually do. The currency of settlement changes, the currency of denomination does not. This distinction is where most de-dollarisation coverage goes wrong. Headlines about a country agreeing to accept yuan for oil describe a settlement change. The pricing usually remains dollar-referenced, which means dollar demand for hedging, financing, and reserves persists underneath. Shanghai's yuan-denominated crude contract exists and has traded meaningfully. What it has not done is displace the reference function, because that requires foreign participants to hold and hedge in yuan, which brings us straight back to the capital account. So the benchmark is the load-bearing element. Until commodities are denominated rather than merely settled in another currency, the system has not moved, whatever the settlement statistics show. The strongest counterargument is about infrastructure and time, and it is genuinely the best case against me. It runs like this. Reserve status is a lagging indicator. Sterling remained a major reserve currency long after Britain stopped being the dominant economy, and the dollar took decades to displace it. What matters is the plumbing being built now: China's cross-border interbank payment system, central bank digital currency pilots, commodity contracts priced in yuan, swap lines with dozens of central banks. Each of those is a rail. Rails compound. And the yuan does not need to replace the dollar globally, it only needs to dominate a block. On this reading I am looking at today's stock of reserves when I should be looking at the flow of new infrastructure. That is a serious argument, and the block currency framing is the part one find most persuasive. I think a yuan-denominated trading bloc is genuinely plausible. But it does not escape the trilemma. Every one of those rails still terminates in an account that Beijing can regulate. The plumbing is real, the willingness to let money leave freely is the missing input, and it is missing by choice, not by underdevelopment. Sterling's long decline is also not the analogy people think. Sterling stayed usable because Britain kept it convertible. The comparison actually argues for openness being the binding requirement. Three things follow. First, expect continued erosion of dollar share in specific bilateral corridors, without a coherent alternative system emerging. Fragmentation, not replacement. That means more friction in global trade, not less. Second, expect gold to stay elevated as a reserve asset for as long as the freezing precedent holds. That is a structural repricing, not a cycle. Third, and returning to where this series started, countries that accumulate yuan through trade surpluses with China will keep facing the same problem Russia faces, holdings that are spendable mainly inside the issuer's economy. That is a dependency generator, and it will produce more client relationships, not fewer. So the headline is half right. The dollar's dominance is eroding at the edges. But erosion is not replacement, and the thing replacing it at the margin is a metal with no yield and a patchwork of bilateral deals. That is a worse system for everyone, including China, which is a strange conclusion to arrive at, and it is the one the evidence keeps pointing to. The falsifiable version: if China materially opens the capital account, I am wrong about the durability of all of this, and I will say so directly in a video. Watch for that, not for payment volume announcements. That closes this series arc. If you want the next one to go deeper on any single thread, the industrial relocation, the gold repricing, or the block currency case, say which in the comments, because that genuinely decides what I research next.